So here we have this information about overnight auto. So we have information that we purchased a 1 year insurance policy for $18,000 in paid cash. And then we have adjusting entries for these 1 month of insurance expense. And I'm actually going to escape out of this really quick so I can type on this and show you those journal entries. So we have, let's just look at one journal entry for March 31, where we would have insurance expense. So a 1 year policy of 18,000. So we need to take that 18,000 and divide it by 12, which is $1,500. And so the journal entry to record a month of insurance expense is a debit to insurance expense and a credit to prepaid insurance. Let's look at another example. So in this example, we have office supplies on account. We have that a physical account on March 31st. So each month we're using office supplies. So let's look at, first we'll do March 31. And so we have supplies expense is the debit. And then we need to determine how much supplies we use. So we take the 5,000 we started with and subtract it from the 3,075 that we have left. And we see that we used $1,925 in supplies. Then our credit is going to be to the supplies account because we have less supplies now. We then have April 1st, and the formatting is going to irritate me. So April 1, and we are recording supplies expense and supplies. So now the difference is that we started April 1 with the 3,075 in supplies remaining. So on March 31st, we had 3,075 in supplies. So on April 1, we had 370,000 in supplies. So we take 3,075 and subtract our remaining 1,085 or 1,185, and we find that our supplies expense for the month of April, this is April 30th, is 1,890, and our credit for that would be supplies for 1,890. So those are some examples of adjusting entries that we need to do for our accounting records. Now we're going to talk about depreciation. So depreciation is an expense that tells us how much we use our property, plant, and equipment. So how much we use our assets that are long term. This is again an accounting treatment that allows us to recognize that things only last for so long. For example, if we buy a piece of equipment, it might only work really well for about 5 years, and then that equipment needs so many repairs or the technology has changed so much that it's time to replace that piece of equipment. And this is fairly common in both in business and life. You think about how often you replace your cell phone or your computer. If you've seen people replace appliances in their house. So this recognition that things don't last forever. And depreciation is the recognition of that. So we record depreciation expense against all of our property, plant, and equipment except for land. Land is never depreciated. So the formula for straight line depreciation is we take the asset cost minus the salvage value of the asset divided by its useful life. So what do we decide is the useful life of an asset? Well, sometimes it's company policy. So if we say we replace computers every 5 years, then the useful life of a computer is 5 years. If we have a trucking company where we do deliveries like UPS or FedEx, if we say that once a truck has so many miles on it, then that number of miles is its useful life. It does not have to be years. It can be things like number of miles. That's also common for airplanes, where airplanes have a useful life expressed in the number of miles that they fly. And so the useful life of an airplane is determined by miles. So let's look at an example of this. So the useful life is how long that is going to last for us. And salvage value is the expected value that's going to be left over, whether we can trade it in and get something against our new purchase. So we have a car that we can trade in, or we have a piece of machinery we can trade in, or if by the time of its useful life, it's just going to be scrap. And so we know that we're going to junk it, but because of its components, we're going to get a value from the junk company when we scrap it. Okay, so we have this example where we have equipment that has been purchased on December 1st, and the cost of the equipment was $26,000. This equipment has a useful life of 5 years. The equipment is expected to be worth about $8,000 at the end of 5 years. We purchased the equipment on December 1st, but it is now December 31st, and we need to record a month of depreciation expense. The first thing that we have to do is we have to calculate how much that depreciation expense is. So if you remember from the previous slide, that is the cost of the equipment, so $26,000, minus the salvage value, $8,000, and then divided by its useful life, which in this case is 5 years. So because we expect the equipment to be worth $8,000 when the 5 years are over, we're only going to depreciate $18,000 of the cost, so 26,000 minus 8,000. So here we have a 60 months. So 5 years times 12 months a year gives us that we're depreciating over a 60-month period. So we're going to take this information and calculate our monthly depreciation. So if we take 18,000 and divide it by 60 months or 5 years, we get that our depreciation expense is $300 a month. So that's what we're going to record in our depreciation for once a month. So where we put depreciation is in an account called accumulated depreciation. So we do not edit the equipment account saying that we're taking money off of the equipment. It is recorded in a separate account called accumulated depreciation. So the journal entry is a debit to depreciation expense and a credit to accumulated depreciation. In a future chapter, we're going to talk about what happens when we get rid of equipment or we sell equipment. You're going to see how that affects the equipment and the accumulated depreciation account. Okay, so our adjusting entry, as I said, a debit to depreciation expense and a credit to accumulated depreciation equipment. So you see that this accumulated depreciation account is labeled equipment. And that is because each account in your accounting record that is an asset that we're going to depreciate needs to have its own accumulated depreciation account. So we don't just have one that mixes with everything. We have one for each type. So if we have an equipment account, then we have accumulated depreciation equipment. If we have a building account, then we also have accumulated depreciation building. Okay, so these accounts have to be matched with each other. They're paired together. Okay, when we see this on our balance sheet, we then see that when we list our assets, that accumulated depreciation is listed in the asset. Accumulated depreciation is what is called a contra asset. So it is an asset account that is paired with this asset account of equipment, but unlike asset accounts which increase on the debit side, the contra assets increase on the credit side. Now, the one thing about contra assets is they have to be paired with a regular asset account. So we just wouldn't have accumulated depreciation if it wasn't paired with an asset, in this case, equipment. So we have these two examples of depreciation. So let's work through these two examples, and then we'll move into some further adjusting entries. So we have depreciation. We purchased a building with a useful life of 20 years, and the building was $250,000. Calculate and record the first month's accumulated depreciation expense on January 31st. Well, when it says it doesn't say anything about salvage value or residual value here. So we can only assume that it's zero. So 250,000 minus zero is 250,000. So we're going to take 250,000 divided by 20 years, and that equals $12,500. And now we want to record 1 month at a time, so we're going to take that $12,500 divided by 12 to get our monthly depreciation, which does not come out to a clean number. It is $1,041.67. Okay, so our depreciation expense, then we would debit depreciation expense for $1,041.67, and we would credit accumulated depreciation building for $250,000. We have that we purchased 12,000 of tools and equipment with a 5-year useful life. We're going to record 1 month. So again, 5-year useful life, we can either divide by 5 and then divide that by 12, which is what I prefer to do, or you can just divide by 60. So 12,000 divided by 5 equals $2,400, which divided by 12 to get a monthly expense equals $200. Okay, so 1 month of depreciation expense would be $200, where we have a debit to depreciation expense for $200 and a credit to accumulated depreciation tools and equipment for $200. In the next video, we're going to go back to our discussion of adjusting entries, which depreciation is one of the adjusting